Let's bring in Steve Liesman now as we get the first reaction, I believe, Steve, from the Fed, from someone on the Fed about that CPI report. What are we learning from Austan Goolsbee here?
Chicago Fed President Austan Goolsbee, as you say, Scott, becoming the first Fed official to react to this morning's CPI report, said it shows progress, continues in bringing down inflation, but we still have a way to go before reaching the Fed's 2% target. But he is pretty upbeat when he says the U.S. this year may equal the record outside of wartime or post-war time for a one-year drop in inflation and do so at full employment. He notes the last time we did this, 81 to 82, was a big drop. It came with high unemployment. He says driving the inflation decline are improvements in supply, accelerating productivity, which if it lasts can help keep inflation down and anchored inflation expectations. He says that it can have strong growth in the U.S. without inflation due to the unwinding of these supply shocks. He is concerned about what he calls external shocks that could throw us, of course, but did not list those, what those shocks would be. He says the key to progress from here on inflation is housing. He says the services is going to come down. Quickly, Scott, I'll show you the probabilities. As you know, 100% chance or 99% chance the Fed stays the same. We haven't seen this in quite a while here. And then you look at the cuts. The cuts now coming seem maybe as soon as May of next year, even March in play as well. You can see, and just quickly, I want to show you now where the new debate's going to be, which is the amount of cuts that are priced in. For using the January 2025 contract, 100 basis points of cuts built in for next year, whereas the Fed, at least in the September forecast, had only 28 basis points of cut built in. So we'll see who ends up being right about that, Scott.
Well, maybe they'll be, if they're data dependent and the data continues to move where it's going to move, then maybe the market isn't as offsides as that graphic that you would show would suggest. Now, internal shocks, geopolitics obviously would be one that he would presumably be thinking about, and what might happen with oil prices in that regard, which has been really surprise, I think most would admit, where oil prices have gone since October 7th, Steve.
Yeah, and I think those are exactly the external shocks he could be talking about. And I don't know that the market is offsides on that 100 basis points of cuts there, Scott. I think it's worth thinking about the idea that there was a lot of commentary this morning, and this is the beginning of what we've been waiting for a long time. Two forces we've been waiting for. One is for lower wages to work their way into lower services inflation, and the second is all of this talk about rents being down, working their way into the housing component. Both of those things seem to have happened, and the thinking is that this is going to accelerate from here. Theoretically, the Fed got tighter today. Inflation came down, the Fed remained the same. The question is the extent to which the Federal Reserve in the coming months and years, if this continues, is going to respond to that and say, you know what, we don't need tighter policy here. We can maybe pull off this soft landing with modest gains in unemployment and have the economy still growing at or just below potential.
Stay with me, Steve, because I want to get a comment from All In Jim, who declared the bear case over today and that the Fed was done, right?
Yeah, Steve, I got a little punchy this morning or earlier in the show. Sorry about that, but I think you've been around to know why I did that. I think, the real question here is I'm watching a lot of commentary from people saying there's 100, 200 basis points of rate cuts. I don't think we need that. I mean, I think what we're talking about just for stock investors to feel enthusiastic is that you get, 2 or 3 cuts of 25 basis points next year because the rate is too restrictive. If you get more than that, I mean, it really implies that something's wrong with the economy. Do you agree? I don't want to see 100 basis points. That kind of scares me.
No, I agree. I do think that the Fed, if it does so, will do so in a measured pace, in part because it's concerned about the return of inflation. I still think inflation expectations are high, and the Fed's going to want to see those come down along with inflation over time. The possibility you have to think about, Jim, to add to your bull case, that we could shortly be printing an inflation number with a 2 handle on it, I think is very important for the Federal Reserve, because I think it's important for the public, and the Fed wants to bring the public along here. There is going to be a rate the Fed will arrive at, which would be a neutral rate, But a lot of thinking right now is that that number might be higher than it had been in the past. If it had been 2.5% or 2% before, maybe it's more like 3 or 3.5%. So the Fed will have some work to do to bring down the funds rate to a place where it's more neutral. But the pace that it does so, I think, is going to be slower than the market expects. But I think the market will really get a charge out of the idea when it does start to reduce rates.
You see this UBS call that the Fed's going to cut rates by 275 basis points next year, Steve? Did you see that today?
That's what I was referring to.
I did see that. I saw that. I think that's very ambitious. I think that is not the Powell I know. I think Jay Powell will be much more cautious than that. He has laid down a marker that he will not be the Fed chair. He's not going to be Arthur Burns, the Fed chair that presides over either continued high inflation or a return to inflation. Sure. He has also stated that he wants to see this economy running below potential to make sure inflation is vanquished. So I think you'll get cuts, but I don't think you'll get ambitious cuts like that.
Yeah, and the unknown is why you'll get the cuts too. We have to wait and see what happens.
Unless, of course, unless Jim is right, and that you do so. Not that Jim's calling for it, but if you get those kind of cuts, the economy's in more trouble than it appears now.
Yeah. Oh, for sure. Steve, thanks as always. That's Steve Liesman, our senior economics reporter.